Ladies and gentlemen, can I have your attention? Firstly, thank you very much for coming along tonight. I'm glad that we managed to put something together that will, I'm sure, be of value to you all. Before we get started, and before I introduce our speaker for tonight, just like to say we'll have plenty of time for questions at the end, so store up all the interesting questions and we'll keep Andrew busy all evening, I hope. Once we've finished, we'll stack up some of these chairs, so there'll be plenty of space, more than you just had, to have a bit of a mingle. There'll be drinks and food afterwards, so please, you are welcome to stay for as long as you'd like after the debate. So, without further ado, I'd like to introduce our speaker. Andrew Goodwin is a senior economist with Oxford Economics, who's kindly agreed to come along and talk tonight. He's a senior economic advisor for the Item Club, who I'm sure you've all heard of. You may not have come across Andrew before, but I have no doubt you all would have heard and read a lot of what he's had to say, because he's in the press quite a lot. So I'm very interested to hear what he's got to say tonight. Andrew.
Thanks, David, and good evening to you all. I've got quite a broad remit tonight. I've been basically allowed to speak on anything about the economy and risk. So I thought the best way to tackle this would be to sort of go through our sort of view on the sort of the global economy, framed within, I suppose, the 5 key questions that we're asking ourselves at the moment, in terms of, I suppose, forks in the road where various economies could go one way or the other, and then obviously what that might mean. Then sort of finish off by thinking a bit about the UK, because ultimately we're all sort of here operating in the UK, and that really is our sort of bread and butter. Just to start with a few sort of slides on where we are now, and the great thing is that standing here today, it's really the first time in probably 6 years that I've been able to give a presentation and actually have an almost universally positive sort of media backdrop in terms of the UK economy. Trying to tell anyone that the UK economy was heading towards a better place at any point in the last 5 years has been a very hard sell. But I think sort of standing here today, I'm hoping it might be a little bit easier. We've got an economy that is now on a path of sustained growth. So for the first time since 2008, we've put back-to-back quarters of positive growth together. Probably going to have the strongest quarter of the recovery so far in quarter one, the quarter just gone. And also, the big criticism we've had of the recovery so far is that it's all about indebted consumers and pumping up the housing market. Well, the great news is that it's not about that either. All the data we're getting recently suggests that finally businesses and exporters are getting on board, and we're actually starting to see the very first signs of this balanced recovery that we've been hoping for really the whole period since 2010. Also, the cost of living crisis, the other sort of bugbear that's affected so many of us since the start of the financial crisis, that's almost come to an end as well. That's unambiguously good news for the economy and for households. Potentially less good news if you plan to wear a red rosette this time next year. But certainly, we're in a much better place now than we were, say, 12 months or so ago. However, while the UK is actually doing much better, things aren't quite so good elsewhere. I think there's much more uncertainty elsewhere, which is almost a sort of complete turnaround from where we were just sort of 12 to 18 months ago. So in particular, you've got big question marks that have emerged over the emerging markets. Since the US Federal Reserve started its tapering of asset purchases last year, investors have become very risk averse, started pulling money out of the emerging markets. Big uncertainty as to where that's going to go. And also, you've got the Eurozone flirting with deflation. We may have moved on from the first and second phase of the Eurozone crisis, particularly in terms of the sovereign debt part of it. We've still very much got the Eurozone on the worry list, still very big concerns about its viability going forwards, and still something that exercises our thoughts on an almost daily basis. So I mentioned at the top that I had sort of 5 key questions about the global economy and then culminating in one key question about the UK. The first question is one that I haven't really touched upon yet, and that's the US. I think whenever we think about our global forecast, the US is pretty much the starting point for it all, and it may not be the be-all and end-all, but it's certainly a phenomenally big part of our forecast. There's a little bit of negativity creeping around about the US at the moment, particularly about some weak data we've seen over the first part of the year. Obviously, the first part of the year in the US, a whole series of sort of bad weather events, horrendous snow in sort of various areas. Certainly something that sort of disrupted activity. But if we ignore all of that, how firm are the foundations for the US recovery, and how much, to what extent, can the US actually drive the world economy forwards? Well, we're pretty bullish about this. We think the US is very much the cornerstone of the global recovery over the next couple of years. In particular, if you sort of think about all the things that may be holding the UK back, so things like the banking sector, the household sector, and household sector debt, you think about what's happening in the US, almost all of them are in a much, much better place in the US. They're much more supportive of the US going forwards. Thinking about the household sector, they've done all the deleveraging already. The household debt ratio is back to much more manageable levels again. Households may not be willing to take on new debt again, but they're certainly not taking money out of the system like we are here in the UK. You think about their housing market, they had a similarly large crash to us back in 2008, a much weaker recovery in activity in terms of either house building or house prices ever since. So there's a lot of scope for the US housing market to come back as well. And in fact, when you sort of go across all of the big drivers of the US economy, almost all of them suggest that things should be getting even better over the next couple of years. I mentioned the banking sector. Banking sector has very low levels of debt now. It has also deleveraged like the US consumer has. So now it's actually in the situation where it's supporting growth quite aggressively. Big increases in lending to the corporate sector there. And obviously contrast that with what's happening here in the UK and what's happening with the Eurozone. It really is sort of as big as night and day. So the US banking sector is very strong. And again, think about some of the other things affecting the US. You think about their manufacturers have become very competitive. You think about the shale gas industry and the sort of transformational things that could happen there. Becoming self-sufficient in energy, reducing energy costs. Almost all of the things that you could think of are very positive now for the US. So we're very bullish in terms of the US outlook. We think the US is going to be growing by 3% plus for this year and next year. So it's really going to be driving the world economy forwards. In fact, it's driving the economy so well that the policymakers in the US, for the first time since 2008, are effectively now taking it gradually off of the emergency settings, effectively taking it off of life support, taking us back towards some form of normality again. It's been tapering its asset purchases, so reducing the pace of QE for the last sort of 3 or 4 months. And we think it'll be hiking interest rates probably in about 18 months' time, maybe even less than that. Certainly Janet Yellen, the new governor of the Federal Reserve, committed the cardinal sin of all central bankers a few weeks ago and actually let slip that they actually think that the rates could go up as early as 6 months after tapering finishes. Tapering is going to finish back end of this year. So that half 2 2015 forecast may actually be a little bit conservative. They may actually start to go up earlier. So I mentioned that I'll talk a bit about risk. In terms of sort of risk for the US, we're very much on the case that if the risks are skewed to the upside, that 3% growth forecast for the US, we think may actually turn out to be a bit conservative. In fact, if the private sector actually accelerates more strongly, so businesses go out and spend their cash piles a bit more aggressively, take people on, if the consumers do the same, if the consumers go out there and the housing market starts to pick up, what you could quite easily get is 4.5%, 5% growth in the US over the next couple of years. And I think certainly if the US were to grow at those sort of rates, it'd be fantastic news for the global economy. And also obviously fantastic news for the UK, given our very strong trade links there. So I think in terms of the US, unambiguously good. I think we're really struggling to see any downside. Where the downside starts to come in is where you think about maybe some of the sort of things I was talking about around tapering and the sort of unintended consequences they're having elsewhere in the world. And that's particularly in what we call the fragile five. Some of these sort of emerging market economies, which have already had 6 to 9 months now of major struggle. So currencies depreciating like there's no tomorrow, massive capital outflows. There's an obvious sort of question that sits behind our forecast. Can this continue, or is this going to come to an end? In terms of sort of the countries involved, it's very much that the markets have started picking on the vulnerable countries. So pretty much you have a very large current account deficit, you're bundled in amongst the rest of the fragile five. So you look at the sort of countries we've got at the bottom of the list there, to India down to Turkey, they are the ones that have been hit worst by this crisis so far. They're seen as being structurally vulnerable, and therefore markets have been betting against them and investors have been taking money out. Now, there's an obvious parallel with the last time we had a financial crisis, sort of back in 95, 96. And if you sort of look at that blue bar there, that's the sort of current account deficits that the countries involved in that were running. So you can see there's quite a clear parallel with South Africa and Turkey, maybe less concern in terms of some of the other ones, in particular India. But you can certainly see why investors and why markets are starting to get a little bit concerned. That's led to some pretty big upheaval in quite a few of these economies. The transmission mechanism effectively has been big capital outflows and big outflows in terms of the exchange rate. So obviously the value of the currencies has been going down. Currencies go down, depreciate, massive increase in import prices, therefore massive increase in inflation. So the policymakers have pretty much only got one thing they can do, That's hike interest rates to try and stop the capital outflows and to try and stop the inflation spiralling upwards. In countries like Turkey, that's translated into some massive increases in interest rates, going from sort of 7 to 12 over the course of under 6 months. So you're sort of almost compounding the effect here. You've got inflation being high, eating into purchasing power. You've got capital flowing out. The country's not an attractive place to invest. And at the same time, any of the debtors are then being squeezed by increases in interest rates as well. So it certainly does leave us a little bit concerned about prospects for some of these economies going forwards. Where we're sort of a little bit more sanguine, though, is again this sort of comparison to previous crises and this idea that this can go on forever. I think we're sort of in very much of the view that these countries now look very much different, apart from some of those current account deficits, to where we were back in the mid-90s. Certainly, a lot of these countries have much larger reserves of foreign exchange, so they can defend some of these capital outflows and changes in the exchange rate better. They're much less indebted, and they're spending much less in terms of servicing that debt as well. So that leads us to be quite relatively sanguine, and certainly sort of maybe not quite as sort of concerned as some people may be about what's been happening. That said, I think the sort of things I was talking about a minute ago in terms of interest rate rises, inflation, and the outflows does mean that the outlook for those countries is significantly worse than it was. Just sort of looking back sort of 10 months ago and looking at how our forecasts have evolved since then, you can see for each of those countries, we've absolutely slashed our forecast for 2014. Obviously, Russia's a bit of a special case because of the Ukrainian situation, but looking at all the other ones, you're talking about knocking up to 3 percentage points off of GDP growth for 2014. So it is a materially different sort of outlook for these countries. What would happen were the crisis to deepen, were this to carry on? Well, we think certainly for those sort of countries that were involved, particularly those fragile five, you would have quite a significant impact. So those sort of forecasts I showed there would go down even further. So you may be knocking another 2 or 3 percentage points off of growth. Outright recession in some of those economies. What you probably see in other economies is probably something that nowhere near as severe. You sort of think about the UK, you think about the US. We don't trade a huge amount with these emerging markets directly. So I think certainly the impact would be relatively contained. So certainly I think instead of sitting here thinking about UK companies, I think unless they were to have a significant presence in these economies and do a lot of their business there, they probably wouldn't see an enormous impact from this. But even so, I think in terms of world GDP, you might be talking about knocking a percentage point off over the next couple of years. So it's certainly something that's sitting on our radar. I think something we're more concerned about in terms of the potential magnitude is what may happen in China. I think all of those sort of discussions then about the fragile five and the like were very much about the sort of almost the second tier of emergers underneath China. China is very much a special case on its own. And in terms of China, it's very much the banking sector and the wider financial sector that we're most concerned about. You can see why China is such a worry for sort of us and for other economists. If you think about how much sort of China accounts for in terms of exports to the developed world, the chart on the left there, or in terms of sort of the bank exposure, there's sort of the x-axis there. China is a much bigger player in terms of the US market, in terms of the European market, than any of these other emerging markets. In fact, you could almost sort of stack that fragile five up together, and they get to pretty much where you are with China on its own. So that's why we think it's the major threat. Why we think it is a threat, sort of full stop, is really that chart on the left there. The Chinese financial sector has exploded over the course of the last sort of 4 or 5 years. Effectively, when the world economy slowed down in 2008, the Chinese domestic demand was ramped up. Most of that came through investment, but a lot of it was financed through sort of credit. So effectively, a credit bubble has blown up in China. Now, what's sort of concerning most people most about this is it's not just a banking sort of credit bubble that's blowing up, it's also the non-banking sector as well. China has a very large informal banking sector. So this is sort of essentially sort of people lending to one another, companies lending to one another, and what they call trusts as well. That's blown up into a relatively large bubble, and there are concerns of what may happen if certainly loans stop performing, if you have large write-offs, what that actually may mean for the flow of credit going forwards. The company sector in particular has been the beneficiary of this, and as I mentioned, it's very much been an investment boom that they've had. And we're getting to the sort of stage now where that investment boom becomes less sustainable as well, where China really needs to start rebalancing its economy almost in the opposite direction to the sort of way we're talking about here. It needs to do more consumption and do less in terms of investment. Now, if you're going to ask anybody to sort of try and pull that off, then probably the Chinese government would be the best people in the world to do it. They have probably the most control over their economy of any economy in the world. But it is no easy feat. Certainly that sort of soft landing is something that could quite easily go wrong. We don't think it will go wrong, and there's a number of reasons there why not. We think China is big enough and has both low enough debt levels and large enough reserves to be able to withstand some pretty big losses in the banking sector anyway. We think the government is so focused on reforming the financial sector and taking steps in the right direction that we think it's pretty much ahead of the game. And I think there is a sense that sort of rebalancing towards consumer spending is probably going to happen in China. There are already signs that wage growth is starting to pick up, that consumers are now actually starting to have the appetite to spend, and that should actually help the economy rebalance as well and take us away from that dependence on investment spending. But it isn't a foregone conclusion. Equally, there are several reasons why you could quite easily make a case for a banking crisis as well. I mentioned those corporate debt levels a minute ago. They are very high. Corporates are quite heavily indebted there. There are big issues with the shadow banking regime. It's not particularly well regulated in China. These sort of things have a tendency to happen outside of the government's control. And they've had a bit of a test run over the course of the last 3 or 4 months where they actually had to bail out one of these institutions, and it didn't go particularly well either. So I think you could quite easily make a case for that actually happening. And in the same sort of way as you can sort of trace back what happened in 2008 to Lehman Brothers. A whole load of things that, on the face of it, don't look particularly dangerous, but when they sort of can combine together into a sort of coherent story, it's enough to tip you over the edge. But as I said, I think very much our sort of view is that isn't a central case. It's something that is fairly unlikely, and in terms of probabilities, something that we only think is about a 10% shot. Again, thinking about what it may look like if were it to happen, we think that were you to have a full-blown banking crisis in China, you would be talking about a very, very deep sort of downturn there. China doesn't really do recessions, but in terms of sort of Chinese growth, 1% would be absolutely devastating. And in terms of the world economy and the sort of impact that would have, that would cause a very significant slowdown across most of the rest of the world. As I say, though, we think that's a pretty unlikely scenario, and certainly something that we think is a fairly sort of tail risk, I suppose you would say. The other question is around Europe, and I think this is another one that has been exercising us for a while now. I think as I mentioned at the top, that the Eurozone crisis was very much a sovereign debt crisis probably a year ago, 18 months ago. We were all obsessed with how long Greece was going to last, whether it would end up falling out of the Eurozone or not. That's sort of moved on now. I think the sovereign debt side of things has actually stabilised quite significantly, and we're actually now into almost a new phase of the crisis, and we're actually now back to economic fundamentals. And the fundamental problem for the Eurozone is whether it's sufficiently strong in its current form to actually continue to grow and to actually continue with positive inflation. The big risk for the Eurozone at the moment is deflation. And it's really a sort of scenario like the one that Japan has endured for the last 20 years. In terms of the data, the Eurozone is doing okay. Were you to put these sort of charts up for the UK or the US, we'd be sort of heading up towards the high 50s. It's not doing particularly well. But certainly compared to where it's been for the last 3 or 4 years, it's doing a lot better. I think there are positive signs in the Eurozone. The big problem is, though, that the banks are still deleveraging. I mentioned the US was very much in the sense that the US had done its deleveraging already. The Eurozone has barely started in terms of the banking sector. In terms of the corporate sector as well, still relatively high debts. Household sector maybe not quite so bad, but it wasn't as indebted in the first place. But this idea that the banks are still restructuring their balance sheets is a major problem, because if you sort of think again about the UK and the US and our experience over the last 5 years and the sort of damage that bank restructuring does to growth, if the Eurozone still has to go through this and it's still only just coming out of the sort of the early stages of recovery, it obviously has quite a big question mark going forwards. It's also a bit of an issue because it's diverting the attention of the European Central Bank away from doing its sort of core job in terms of managing the economy. So the European Central Bank is obsessed by the asset quality review that's coming up later this year, and really sort of thinking about what it means for the banks. But at the same time, it's almost forgotten about the fact that it's facing deflation as a potential threat. It talks a lot about what it might do if it were to become a reality. But the problem is, if deflation actually ever did become a reality, it'd be too late for the ECB to do anything anyway. They should have done things before that. Why deflation could be a problem is this idea here. We think there's a massive amount of spare capacity in the Eurozone. And when there's a lot of spare capacity in an economy, effectively it squeezes wage increases and it squeezes prices because of the impact it has on profit margins. And you can quite easily end up with prices just continuing to spiral downwards. Obviously, as soon as prices start to fall, the logical thing to do as a consumer or a business is to actually just sit there and wait for them to fall, because if you're buying your good or your asset today and you know it's going to become cheaper tomorrow, you just quite simply wait for tomorrow. Exactly what's happened in Japan. Which is why it would be too late were the ECB just to be good to what they're saying now, and were they to take action once deflation had actually hit. They should be taking action now. They should be really getting ahead of the game. If deflation were to become a reality, now we think that could be quite a long and protracted problem for the European Union, or for the Eurozone. We think were deflation to hit, you would have to throw so much at it in terms of things like quantitative easing, potentially negative interest rates, that it would probably take a couple of years for the Eurozone to get back out of deflation again. So certainly it would be long enough for those sort of behaviours to become entrenched, that sort of waiting for tomorrow in expectation of lower prices. It would certainly send the Eurozone back into recession, and certainly I think a recession that would be relatively deep as well. I think what would be even more serious in terms of the potential impact would what it would do in terms of the social and political side. You think about what it may do to Eurozone unemployment, you could quite easily add another 5-6 million people to the Eurozone unemployment count. And we already know that the political situation in Europe is pretty tenuous because of the fact that unemployment is so high in the first place. And I think critically as well, what it would also do is deflation is a real nightmare for debtors. Obviously, if you have deflation, if prices start to fall, the real value of your debt starts to go up. And if you're Greece, you have an enormous amount of public sector debt sitting there that effectively at some point makes your debt untenable. You have to step away from it. And as soon as Greece defaults, obviously Greece is then effectively de facto out of the Eurozone. And that becomes not just an issue really for Greece, but potentially for Portugal, Spain, even for somewhere like France, if deflation was serious enough and became entrenched enough. Now again, it's something that we think is fairly unlikely to happen, but it's something that's sort of sitting there on our radar in terms of sort of potential outcomes for the world economy. And I think if we're talking about probabilities, we may say something like a 10% shot. And the last sort of major sort of global question is probably the one that's come up sort of most recently. It's obviously the Ukraine situation. Now this sort of scenario for us is probably the hardest one to model, because this is where sort of the scenario and the parameters that we're trying to model leave the economics world and enter the political world. And in terms of the economics, it's something that there's very little there to hang our sort of hat on. In terms of the political situation, I suppose the thing that we'd be most concerned about were if the situation were to escalate and were to get some sort of disruption in terms of of gas supply from the Ukraine. The sort of impact that may have on our sort of gas prices, both the prices that the customers are paying and that companies are paying as well, would then potentially obviously drive up inflation, eat into purchasing power and slow demand in that way. I think were things to get even worse, and were you to actually then sort of have the situation escalate and Russia were actually sort of to be sanctioned, whether to be some sort of tit-for-tat trade sanctions, that could potentially then spread into the oil sector as well, because obviously the Russians being relatively large oil producers. Under that sort of scenario, where you have almost the sort of worst-case scenario, you could be conceivably looking at the UK GDP forecast coming down by a percentage point or two. So it's not an insignificant sort of problem. But I think the key for this sort of scenario from our point of view is that this is a lose-lose for everybody, because it's not just the UK and the rest of Western Europe that loses from this. Russia loses as well, because if Russia were to drive us down that sort of particular road, the sort of sanctions and the sort of capital outflows that would result would cause major, major problems for the Russian economy. And we certainly think of all the economies that we sort of study in this type of scenario, Russia would actually be hit worse than anybody else. So that's another reason why we just don't see this happening either. So when you sort of weight all those scenarios together, you think about the US upside on one sort of hand, which we think is maybe a 15% shot. You think about our baseline, which we think is about a 50% shot. And then you think about those three downside scenarios, which probably range somewhere between 10 and 15% each. What you get is a risk-weighted forecast, which is ever so slightly weaker than our baseline forecast. So our baseline is what we think is the most likely thing to happen. In terms of the baseline, we see a very nice pickup in the US over the next couple of years, so almost 3% this year and 3.5% next year. So a couple of tenths lower, particularly next year on the risk-weighted forecast. And almost everywhere else, things are getting better. Even in the Eurozone, that 1% for this year compares with a minus 0.5% for last year. So we're certainly heading in the right direction. The emerging markets, heading in the opposite direction, heading south, but still sort of 7.5 or 7.25 for China, just under 7. It's not the end of the world. It's certainly nothing that's going to derail our recovery here in the UK. and it's something that I think the Chinese authorities would quite happily put up with over the course of the next couple of years. So where does that actually leave us here for the UK? Well, I mentioned at the top that the nirvana that we've been chasing for the last couple of years is this sort of sustained balanced growth. And I mentioned that we've actually been sort of heading vaguely towards that over the course of the last 6 months. Does this sort of picture we've sort of scoped out here for the global economy actually help us along that road? Well, I think the answer is very much yes. I think the sort of pickup that we're expecting across most of the economies, in particular the sort of very strong pickup in the US and that sort of much weaker pickup, but certainly sort of moving in the right direction in the Eurozone, plays very well to our sort of strengths and the sort of places that we trade with, and the sort of places also that will help business confidence here. The consumer sector in the UK is looking much better. I mentioned at the top that real wages are increasing again, so consumers, we think, are very much on the road to recovery. Housing market also doing quite nicely. We've finally started building houses again. Housing starts up about 30-40% year on year. That's set to continue. So those two pillars are very much there already. In terms of the investment pillar, the investment outlook's now finally looking very good as well. Throughout the last sort of 7 or 8 years, we've seen companies literally stockpiling cash. That chart on the left there shows the amount of money that companies have sitting on deposit. So literally doing nothing, sitting in banks at the moment, as a proportion of GDP. And that level has increased by about 50% over the course of the last sort of 6 or 7 years. So companies are sitting on an enormous cash pile, which could quite easily be deployed where the opportunity is there. What they're telling us now as well is that because that global situation is steadily getting better, because some of those risks are still skewed to the downside, they're not maybe as serious as they were, say, a year or so ago, particularly in the sort of the case of the Eurozone, that now they're getting to the stage where they're thinking that now may be the time to spend it. That promise of stronger growth at home, stronger growth abroad, does present does sort of push that sort of investment opportunity into a much better light. And certainly all of the surveys that we sort of monitor, and this one here is from the Chamber of Commerce, are all telling us that firms are now very much sort of in bullish mode. They're thinking that 5 years of investing on barely a care and maintenance basis is enough. Now is the time to go out there, replace their machinery, and start really sort of building up their capacity for when that recovery comes through. On the export side, also pretty positive now. Obviously you can sort of feed through those forecasts I showed just a minute ago into what it means for UK export demand. We think that export growth, or the potential for export growth sort of in the UK will double over the course of the last couple of years. So world trade weighted by our export shares going from about 2.5% growth last year to somewhere around 5% this year and more than 5% next year. So the opportunity really is there for exporters. In the near term, that may be derailed a little bit by the fact the pound has strengthened a bit over the last sort of 6 months or so. But I think moving forwards, we actually expect the pound to give back some of its strength against the US as that strong recovery comes through in the US and as it actually moves towards tapering and ultimately hiking interest rates. So in terms of competitiveness, UK competitiveness should improve as well. So that double whammy also looks pretty good for exports. So when you actually drag it all together, the picture we think for the UK actually looks pretty good. The height of those bars there effectively shows our forecast for economic growth, and the dispersion across the various colours shows the balance. And you can certainly see over the course of the next 3 to 4 years, we're expecting a much stronger and much more balanced recovery than anything we've really seen since the financial crisis hit. There is obviously the rider that those bars are still quite some way short of what we used to achieve prior to the crisis, but that was obviously with a massively inflated banking sector, a government spending money like there was no tomorrow, and the consumer doing its bit as well. We're never going to get back to that sort of stage again, but certainly I think the sort of forecast that we're scoping out there does look pretty optimistic. I just want to finish by thinking about some sort of homegrown risks and some risks to the forecast there, and I think these sort of together also demonstrate that we're in a better place. Because I think were I to put a slide up like this, say 12 months ago, almost all of the risks would be somewhere underneath the baseline. Where I'm putting them up now, we've got a baseline that's pretty much in the middle, and the risks are pretty much distributed around it. I think that there is very much the potential for companies to come back to the party in a much more aggressive way. I mentioned that companies are telling us they plan to invest. We're a little bit sceptical. We've had our fingers burnt on this one quite a few times in the last couple of years, forecasting an investment recovery that hasn't come through. There is a very good chance that now that companies are actually seeing growth in the UK, now they're seeing the position is better elsewhere, they may really pile in, really sort of ramp up their spending. Were they to do that, it would boost output, it would create new jobs in the economy, and that would almost create this sort of virtuous circle of stronger growth and stronger demand. There's also a bit of upside, I think, from the housing market. Particularly, I think, if the Help to Buy Part 2 takes off. So this is the mortgage guarantee part of the Help to Buy scheme. I think were that to really get house builders involved in quite a big way, and were it to actually sort of really boost the feel-good factor amongst consumers, you could actually see the consumer take off. The only sort of sting in the tail for that one might be that if were the consumers to take off in that way, you may actually see interest rates rise a little bit earlier than we think. At the moment, we have interest rates rising in the third quarter of next year. I think were you to see a much more aggressive consumer upturn, that may scare the bank and they may go a little bit earlier. On the downside, there's obviously the flip side of both of those two. We've had our fingers burnt before on the investment side. We could have our fingers burnt again. We're pretty confident we won't do, but certainly I think there's a concern that were the investment side and the export side not to pick up in the way that we expect them to. If you think back to that chart before, the consumer bar isn't doing a huge amount. It certainly doesn't push on from where we are now. So I think were they to go into reverse, then certainly the growth forecast would slow down a bit. And I suppose our main concern in terms of the UK and in terms of policymakers is simply that the MPC, the Bank of England, just loses its nerve. Now, I think most people expect the Bank of England to keep interest rates on hold until well into next year now. The bank have been trying their very best to actually tell people that that's what they plan to do. I think were they to move more prematurely, that would be a danger that maybe some of those external sources, or the investment source and the export source, may not have come in on stream sufficiently to be able to offset what it may do to the consumer. There's also still this sort of idea that we're not entirely sure about the distribution of consumer debt. And I think were the Bank of England to raise rates very quickly and very aggressively, then there is still a little bit of a sort of nagging down in the back of our mind about what they may actually do to the household sector. But I think they are very much sort of tail risks, and I'd very much stress that in terms of the sort of risk profile, certainly for the UK, things are much more evenly spread than before. And I think it's that sort of more upbeat and optimistic note that I want to leave on. I think our sort of key message is that the situation has turned around significantly over the last year. The UK is now doing very well relative to where it was. And if anything, and again talking about the risk side, if anything, we're probably more concerned about things outside the UK now than we are internally. Thank you. Right, does anyone have any questions?
With regards to the US and the UK, how much of that good news do you believe is factored into the stock markets? Because one, clearly I have a personal vested interest, but more importantly, as a layman, I know that there's a big psychological kick. If the US market's going up, US consumers buy, they spend.
I think certainly I wouldn't expect the US or the UK stock markets to continue going in the way they have been. I think markets have penciled in the impact of a sort of stronger economic recovery into their thinking already, and are a little bit ahead of the game. So even if the US does accelerate up to sort of 3 and 3.5, don't expect that to sort of mean an equivalent increase in sort of stock market growth as well. But equally, I wouldn't expect the stock market recovery to go into reverse. I think all it'll do is it'll settle down into a more sustainable sort of growth path. So we may move from the sort of high double-digit growth that we've seen over the last sort of year or two into something that's somewhere sort of in the 5 to 10 range, maybe somewhere in the middle of that range. So I think, yeah, certainly unlikely to reverse, but probably unlikely to take off either.
You speak a lot about growth, economists often do. What about the distribution of wealth within growth, with particular emphasis on the UK and perhaps somewhere like Spain, and perhaps even Egypt as an outlier?
Yeah, I mean, I suppose that's that is the underlying problem, and to some extent that underpins that sort of cost of living crisis. The idea that even though the economies of the world are starting to recover, and in particular the UK has started to recover over the last year, it's been very slow to show up in sort of consumers' pay packets. I mean, I think that is a medium-term problem that we've been probably heading down that road ever since probably the 1970s or so. And I think it's one that, unless you have a very sort of a very regressive tax regime, one that is very difficult to actually do much about. I think policymakers, there's very little in terms of practical levers, particularly on the macroeconomic side. Thinking about the Bank of England or what have you. there's very little they could actually do to actually improve the situation. And even on the fiscal policy side, you sort of think about the debates you may have around sort of income tax rates and the like as well. And you think of, for instance, what's happened in France with the very high top rate of income tax there. That seems to have had a very, very damaging impact on growth. So even pulling those sort of levers isn't necessarily the solution either. So I'm not sure, personally, I don't think I actually have a solution to offer to that debate, and I'm not sure that many economists do either. I think it's something that we've been observing for a while, but just simply haven't managed to turn around.
Lots of uncertainties around this one, I know, but do you think that the Scottish independence vote has the potential to cause a wobble to the wider UK economy, or is it just going to be a blip and you think it's a Up until today, I'd have been fairly mute on the point, because we actually published quite a big report today with Weir Group up in Scotland, which was carried on sort of BBC website and the like today. So I can now talk about it. I was almost gagged until today. I suspect, I mean, first of all, in terms of the independence question, our research has very much come out on the side that it isn't a good thing for either Scotland or the rest of the UK. The transaction costs involved with having separate currencies would be significant. The practical difficulties in separating up pensions and the like as well, very difficult. And the sort of the halfway house that the SNP plan in terms of the currency union is something that doesn't really work either. It requires rules that are so strict, there's no point in breaking up in the first place. If you're going to have the UK refereeing Scotland's fiscal policy, why does Scotland want to be independent? In terms of the uncertainty factor, I'm not sure I think were you to get a yes vote, and then you had the prolonged period of negotiation, then I would be concerned. Because I think if we have the yes, if everyone knows it's going to happen, but we don't get anywhere near resolving things like the currency union or anything else, that's a tremendously difficult situation for all companies to face. Unless you have almost sort of daily updates from how the negotiations are going, how would you know how to plan for that eventuality? Which is obviously one of the problems of actually having the vote in the first place. You're voting for something where you've actually no idea what you're voting for. I think up until sort of September, I'm not convinced it's having an enormous impact. We get it sort of mentioned in passing when we talk to people about their investment plans and the like, but they tend to suggest to us that it's not significant enough to derail sort of very, very large projects, unless they're talking about something that is very geographically centred on a part of Scotland where potentially it may not look so good after breakup.
What about the euro? Is the UK better in or out of the euro?
That's one we haven't published any research on yet. Yeah, I mean, I think that to some extent there's the same problem that we have with the Scotland debate, in that we don't really know what we're voting for. Obviously the leaders' debate sort of yesterday and last week have sort of given us a little bit of information, but you've still got the fundamental problem that if we were to leave the European Union, are we going to be treated like Norway and Switzerland, or are we going to be a pariah that no one will trade with? We just haven't got any idea, and until you actually know what sort of situation you're voting for, it's very difficult to have an informed opinion or give any sort of scenarios about what may actually happen. We've done a little bit of sort of thinking about it, and I think we'd probably just about come down on the stay-in sort of path on the basis, similar sort of arguments to Scotland, the extra costs of transactions and the like for being outside. But I'm not sure we're quite as hard and fast on that one as we are with the Scotland one.
My other question, looking at a country like Brazil, which a few years ago was doing quite well, what did they do wrong or what did they do right that has caused this situation? Is there any lessons that we should learn?
One of the big sort of underlying problems of a lot of these sort of emerging markets, and particularly the ones that got into trouble, are that they have particularly poor domestic structures. So in particular, widespread corruption, money sort of not going where it wants to go. And that's really sort of harming investment. It's harming investment domestically, but particularly it's harming investment from outside as well. Brazil, India, both classic examples of these sort of problems. It's going to be very difficult to make significant headway until the politicians actually get a grip of this in both countries. Elections coming up in both, we have lukewarm expectations for things gradually changing. But I think until they do it, until it's actually easier to do business in these countries, they are going to continue to struggle in this way because they're just not going to attract the sort of investment they need.
On a similar note, did your economic outlook for China include or factor in the fact that there's a slight slowdown in the internal demand, and also the new government is cracking down on corruption, so they will slow down luxury spending. So we can see some companies already issue, not warning, but you can see a decline in sales and profitability. So does that explain a slight decrease in their GDP forecast?
It does, yes. I think sort of our view is that of all the sort of things that are going on in China, I mean, obviously the government's trying to engineer this sort of slowdown, and it has itself set a lower target for growth over the next 5 years than it's sort of experienced over the last 5 or 10 years. And I think our sort of forecast does assume that the government really gets on top of all the sort of problems, so shadow banking, corruption, sort of money laundering, and all of the other sort of issues that are there, but tackles it in a way that is still fairly sympathetic to the growth environment. So it doesn't go overboard. It tackles it sort of almost behind the scenes and in a sort of fairly low-key sort of way. I think sort of medium term, we're still pretty optimistic about China, and I think our sort of view as well is that the sort of growth you're going to see in China becomes much more attractive to the UK as well. I think the further on you get, I think the sort of switch from investment to consumer spending is going to be fantastic for countries like the UK, where we do a lot of exporting of luxury goods, whereas previously we haven't really tapped into the China bandwagon because we don't produce the sort of investment goods that Germany produce and that China demand. So I think you hear a lot of criticism about UK firms not getting into China, but I think we probably will start getting into China in quite a big way over the next 10 to 15 years.
Well, David Cameron made a very good trip to China. I think he really won hearts and minds of Chinese people recently. So.
Yeah, and I think those sort of those visits help, and I mean that's becoming almost an annual event at the moment. And I think certainly all the feedback we get is that sort of thing is positive and is helping to really sort of create the right relationships.
What about the impact on the economy from all the openings of the labour market now with Eastern Europeans coming over? Do you have a view on Romanian Bulgaria, particularly in the market quite a bit?
Yeah, I mean, I think one thing it has done sort of over the last 3 or 4 years, it's probably exacerbated this sort of real wage squeeze on the basis that because we've had so much labour to choose from, companies have been able to keep wage costs down. Effectively, sort of the quantity of labour, the supply of labour has been much greater than the demand for it, and therefore that's sort of pushed down on wage growth. In terms of sort of the latest sort of increase in the latest expansion in the number of countries that can actually sort of come here and work freely, our research suggests that the impact's been negligible. It's 2 fairly small countries that are a long way away from the UK that don't have particularly sort of similar characteristics either in cultural, language, or any other terms. So I suspect, as with most of these things, the politicians address this up to be something that's much more important than it really is. But I think certainly the rest of the migration story and the European Union story from 2004 onwards, particularly the A8 accession, that has been quite a big influence on the labour market in particular.
You mentioned potentially having deflation in Europe not being good, and you referred to Japan. What could we learn from Japan to avoid having the deflation effect?
I suppose the most obvious, or the most immediate thing we could learn is not to go there in the first place. So it's to stoke up demand sufficiently in the near term that you don't even go there, that you sort of pull yourself away from it, almost sort of like a plane that's sort of heading down towards the ground. You just yank the controls back up again. The ECB could do this quite easily. The ECB is very conservative in its outlook, mostly led by Germany, and Germany's sort of irrational fear of inflation, if you like. The ECB really should be thinking about quantitative easing. It works very well in the UK and in the US in terms of sort of putting a floor under the recession, getting the economy moving again. It's the sort of thing that could easily be done in the Eurozone as well. Admittedly, there are bigger political considerations in the Eurozone because if you're buying sovereign bonds in particular, there are issues about which bonds you buy. But if that also helped the Greek situation as well, then really I think it would be a win-win situation. And I think we are eternally disappointed in the ECB that all they do is talk and that there's never any action. And I suppose our concern would be that in the end the talking just isn't enough, and that it could well be they take it too close to the wire and then act too late.
Given the answer you just give, and that the inflation rate has continually been dropping, how are you going to raise
Part of the reason is that at the Eurozone level as a whole, the German inflation rate is going to pull everyone up over the next couple of years because they've got a massive increase in the minimum wage coming through. So yeah, we're talking about, I think, some workers getting sort of 20-30% pay rises, which is pretty big, phased in over the course of several years. So that should sort of keep the German inflation rate up, and that then obviously, Germany being 33% or so of the Eurozone, sort of keeps the rest of it up. We're also optimistic that demand will sort of stabilise in some of the other countries. I think what we've seen over the course of the last 6 months is that we're finally getting signs that Greece and sort of Portugal, Spain are coming out of their tailspins. They may not be recovering strongly, but they're at least they're ceasing to decline in the way they have done over the last few years. And I think were they to sort of to stabilise and then hopefully push forwards, that should also be enough to sort of prevent deflation in those countries. But we are, I suppose we become more concerned about that one by the month. I think we're now up to 5 of the 18 countries that are actually in deflation, or 19 countries I think it is now. So we are, they're all small countries, but each extra country that gets added to that list, we get further and further down the line towards hitting that scenario.
Given what you just talked about euros, do you think that euro still remain relatively strong against sterling?
We are eternally confounded by the strength of the euro. There is no logic to it whatsoever. The only thing we can assume is that markets have forgotten that there are another 18 countries and they just see Germany, because there is no logic to why the rest of the Eurozone should be, or why the euro should be holding up. We have a fairly large depreciation. We have about 7 or 8% against the dollar over the next couple of years built into our forecast. That's another thing that helps avoid deflation, because obviously that should then sort of push up prices a bit as well. But certainly I think were the euro to maintain its strength, or even heaven forbid get stronger, then that probably actually would increase the probability of that deflation scenario coming true, because obviously that's just going to have sort of keep pushing down import prices and potentially cause even greater problems. But so I think I'd be amazed if you could find anyone who could give a sensible explanation for why the euro is as strong as it is.
One top priority critical factor that you think needs to be right to get the upside there?
To get the upside there, I think it's probably that we need to keep the global situation on an even keel. I think certainly whenever I go and talk to any sort of clients who are in this sort of situation, their biggest concerns seem to generally be outside of our borders, and they tend to be sort of fairly news driven. So I suspect it's things like making sure the Ukraine situation doesn't escalate, making sure the Eurozone doesn't sort of collapse into these sort of problems, and I think it's seeing things like the US recovery coming through in a big way. That seems to be, certainly when we talk to investors, that seems to be the key factor for them. I think they're actually relatively sanguine about the UK domestic situation. It's just issues outside our control. I think that we've got to rely on everybody else. I think maybe 12 to 18 months ago that was different. I think 12 to 18 months ago people were concerned about the domestic situation as well. But I think the fact that Grace roared back quite as nicely as it has taken the domestic concerns off of the agenda for the time being.
Can UK household debt go on rising forever?
Well, I mean, in some ways, this is one of the myths of the recovery so far. I mean, certainly, I think we need to believe or read some newspapers. They tell you we're having this debt-fueled boom and we're all about to go to hell tomorrow. The reality is, household debt's actually been decreasing for the last 6 years. It's still on a downward trend as a percentage of household income. Now, there are some households who do have very high debt levels. This isn't evenly distributed across everybody. And certainly there are some households who I would be very nervous about once interest rates start rising. But I think as a whole, the UK household debt ratio has gone from about 170% of income down to about 140. Now, it's still higher than the US, that chart I showed right at the start, but 140 it's getting back into a more comfortable zone. It's probably higher than we'd like it to be, but it's certainly not an immediate concern anymore. And I'm quite happy that the UK recovery can continue onwards without having to resort to actually using credit to boost it up again. And I suppose one other sort of factor to mention as part of all of that is that I suppose if we sort of think about the 10 years up to the crisis, the big increase in household debt wasn't sort of people just going out and spending sort of willy-nilly on goods and services. It's generally people taking out mortgages and investing in their houses. And that was matched by a much, much larger increase in the size of household wealth. So if you're sort of trying to match sort of liabilities to assets, we're still in a relatively sort of good situation on that score as well. So I'm relatively sanguine about that.
To what extent have you discounted the risk of a change of government next year?
Well, we tend not to try and sort of take a view one way or the other, partly because we sort of see it as being out of our direct control, it's being a political issue rather than an economic issue. In this sort of instance, we're also we're happy that the two parties are sufficiently close together that the sort of, certainly I think if we're talking about the next 3 or 4 years, the impact of a change of government will be pretty small. I think where you're sort of thinking out towards maybe 2020, then you would see the differences in their sort of fiscal outlook start to come through. For instance, the current government would like to balance the deficit, it would balance the budget entirely. The Labour Party would like to balance it on a day-to-day basis, so current spending, and would like investment spending to be sort of financed by borrowing. That's a difference of getting on for sort of 25 to 30 billion a year, but it would take quite a while for that to actually sort of filter through and have any sort of material impact. And to be honest, once you get that far out anyway, that's far enough out for economic forecasters to bury their heads in the sand and forget about it anyway. Is there any more?
Well, if there's no more, I think we'll say thank you very much, Andrew.